Hey, good morning, everyone. Marty Mazzori here. It's the 17th of February, 2024 with your weekly economic snapshot. Today we're going to do the usual, talk just for a few seconds about our index score, share a handful of inputs with you. I do want to talk about confidence this week among various actors in the economy, and then run through some commentary from the latest corporate earnings reports. In front of you is our simple graph of our PWA index. We actually took a leg lower after, I think, 3 weeks or so of some nice improvement in terms of our assessment or our score of overall economic conditions. Dropped back 4 points today to a negative 19. Still in that area that says recession odds going forward are too high for comfort. As for some of the inputs, there's actually 47 in total in our index. We'll start with retail sales. We already touched on this in the video that we shot on Thursday, but I just thought I'd show you the chart. Yes, retail sales really took quite the leg lower versus expectations. This is the Redbook weekly retail sales, and you can see it's, in terms of rate of change, has dropped notably as well. And of course, this is what retail sales tends to trend like heading into recession. Now, not all downtrends lead to recession, but this one looks pretty compelling, as it has for a while. So again, jury's still out. As you know, our base case says that risk is not small here, that there will be a recession in the not too distant future. Now, initial jobless claims actually improved. They came down a little bit. However, continuing claims continued to increase. So folks, what we have here, I think, quite clearly is a case of labor hoarding. I think I mentioned this in the last video. You've got companies that really had a devil of a time attracting and retaining employees as we were recovering from the COVID shutdowns. And despite the fact that there is some weakness across many sectors, we're not seeing massive layoffs just yet, simply because once you've got them, you want to hang on to them after what you just experienced. What we are seeing, though, is a steady decline in job openings, and I don't have it here, but a quits rate that is declining as well. And those are signals of a weakening labor market. And so, again, I think this is somewhat of an anomaly here, has to do with the concept of labor hoarding. Now, that kind of conflicts with what you're hearing in the news every day about layoffs. Cisco, most recently, of thousands and thousands of people. A lot of that's happening in the tech sector. And remember, folks, it is small businesses that really employ Americans, by and large. And it's really in that small business space is where we're seeing the labor hoarding, and that's consistent with what we're seeing in the small business surveys. And I'm going to share that with you here in a second as well. Capacity utilization, and that's to the extent that U.S. factories are running near full capacity. You can see that continues to roll over here, 78%. And you can see the look here. Not every time does it need to run into recession. Remember, when we back tested here to 2015-16, we almost got there with our indicator, but we didn't, and we still had an expansion going on. But this, again, this is part and parcel, typically, to a weakening economy. Commercial and industrial loans, noisy, but trending lower, back into the negative on the last report. And then CPI. Earlier in the week, I showed you export and import prices. I made the case that there are some stagflationary forces brewing, and I think that is a not small concern going forward. As you can see, headline CPI dropped a little bit to 3.1, but that was 0.1 higher than expected. And month on month, we actually are seeing a pretty steady increase of 0.3. And of course, folks, annualize that and look at this, and you're way above the Fed's 2% target. When you look at core, which X's out food and energy, it's actually worse. We've got 3.9%. And then a 0.4% month on month. So falling gas prices, because gas isn't in the core, probably speaks to the fact that this is more tame than this one. And then producer prices came out yesterday. 0.3% was way above what was expected. I think it was a minus 0.1% that was expected. And then core is moving at a 2% clip, and headline at 0.9%. That's year over year, which sounds pretty benign, but it's stopped falling. And as you can see on a month-on-month basis, it's looking like it's rising, or at least it did this last month. Small business optimism, I mentioned that survey, that rolled back over. It was looking a little better. We can see we dropped back down to 89.9 historically. That's not an optimistic overall view among small businesses. You can see hiring plans have ticked down. Doesn't mean they're laying people off. It just means they're not expecting to hire like they were, and they're not expecting to be spending much money on growing their business right here. So not a small degree of pessimism coming out of the small business space. I do want to remind you, though, that among larger companies, perhaps, that show up in the Institute for Supply Managers surveys, we got a big bounce in the right direction among services, and we've got manufacturing about to come out of the contraction zone here in terms of sentiment, if indeed this continues. So that would be something optimistic to consider about the state of the U.S. economy. Consumer confidence continues to ramp higher. Now, I will submit that there is a huge correlation to the stock market here. That consumers, and I've charted this for you before, that consumers tend to be optimistic when their 401k balances are improving. Also, in terms of improving optimism, is from Homebuilders. This is the housing index. So the overall index is still in contraction at 48. Anything below 50 means that the sector is contracting, according to this survey. However, when you look at things like the current situations element, that's this orange line here, that just peaked up to 52, which is expansion. So they believe their current dynamics are improving. And the future outlook jumped way up to 60, which is firmly in expansion territory. So for whatever reason, I assume maybe they think mortgage rates are going to continue to fall. Homebuilders for last month in the survey feel pretty good about their go-forward prospects. However, on the ground buyers traffic, despite the current situation's attitude improving, it's a very low 33. So they're not seeing a lot of people walking into their model homes and looking around. So that has yet to happen, but their expectations are that it's going to. Now, something I think I showed you here recently, and this alongside the ISM positive outlook or improving outlook with manufacturing and with services, is the prices paid ramping up significantly in services to 64, and quite the jump from 45, 46 all the way to 53 for manufacturing, folks. So that, if you use the first half of my inputs and look at the waning economic conditions, and then you see inflationary forces like the CPI, and here ISM prices paid, and then the import and export prices that I featured on the last video, you put those together, and the sum of that is stagflation. And as we've written about extensively for the past couple of years, strong underlying structural forces that have to do with a regime shift to a labor-friendly way of doing things as opposed to the old capital-friendly way of doing things. And we've studied these things for many decades, and they go through multi-decade phases. Well, a labor-friendly, populist, time to redistribute the wealth sort of regime is inflationary almost by definition. It engenders protectionism, deglobalization. It essentially goes in direct contrast to the things that have been disinflationary for the last 40 years or so. And if we aim to pull away from these disinflationary forces, and I'm not judging things one way or the other, I'm just giving you the reality of it, that's going to lead to inflationary forces on a structural basis long term, which is why we think that once we get out of whatever's left in this cycle, and we think that could ultimately culminate in a recession, as we come out of that, I think the Fed is going to have to completely abandon their 2% inflation target. And I think they're probably going to have to revert to some sort of capping of the yield curve like they did in the 1940s, or yield curve control, where they allow inflation to actually run hotter and inflate away what is now something like 130% debt to GDP. The last time we had over 100% was 1945. And that's precisely how we did that. If anyone's interested and wants to shoot me an email, I can send you those commentaries where we kind of described what I just threw at you right there. So as for commentary from companies, we're still in earnings season. As I've mentioned, we pay Peter Bookvar for his excellent research. And one of the things he does for his subscribers is breaks down the conference calls and the commentary from earnings. Another premium research firm of ours does that as well. And sometimes I mix the two, but today I'm just kind of running through what Peter has to say. And let's see. Shake Shack, we entered 2023 with strong momentum in the fourth quarter, and our marketing strategies delivering positive traffic, our operational focus achieving further margin expansion. Outside of weather-impacted weeks, though, we saw the underlying strength of our fourth quarter trends continued into January. And while we're not providing specific numbers around February, our trends improved. And by the way, I didn't mention this. I mentioned it the other day, I think, that there was some pretty bad weather in January. So we have to think about that also in the context of those weaker retail sales. Martin Marietta Materials, we anticipate healthy demand in public and heavy non-residential construction will largely offset softness in the residential sector and expected moderation in light non-residential construction. This morning on the written blog, I replied to a comment from a friend of mine and client who mentioned all the weakness in the U.S. economy and that it's still holding up and so forth. And in my reply to him, I suggested that this high fiscal spending, along with savings, along with high spending or consumer spending down their savings in 2023 is indeed an anomaly. Typically, they counterbalance one another. When the consumer pulls in, the government steps up to try to fill the gap. When the consumer is strong and active, the government tends to run smaller deficits because it's not necessary. Last year, we had both in tandem. That led to really high nominal GDP and high GDP overall. But by definition, I think that's unsustainable. And I just mentioned inflationary forces that are structural. Imagine what that kind of action can do to inflation going forward. And we're beginning to see some of that, which we've been talking about and what the market's been reacting to here of late. Airbnb, after seeing softness in October around the attacks on Israel, they saw a pickup in demand in November and December. And from their own commentary, as we come in from that strength, we're seeing really stable demand coming at the start of the year. AutoNation, now, as we know, there continues to be mixed economic signals in the economy and concerns over affordability. But from our perspective, consumer demand for new vehicles remains robust. During the quarter, our total new vehicle revenue increased 7% and unit sales 5%. This reflected strong import growth as well as the seasonal uplift in luxury sales. Coca-Cola, during the quarter, we saw strong consumer demand across Australia, India, Latin America, Japan, and South Korea. In North America, consumer spending in the aggregate is holding up well. From Marriott, we continue to experience strong momentum in our business around the world thanks to solid demand for travel in our diverse portfolio of 30-plus leading brands. Fourth quarter, global room nights rose 5% year over year, leading to a 6% leisure transient revenue growth worldwide. Demand from small and medium-sized corporates remained robust. Large corporates are still lagging, but they do continue to post volume increases. Now, on the flip side, those were pretty positive commentaries that I just shared with you. The not so positive Cisco Systems. Before turning to our performance in the quarter, I'd like to start by commenting on the demand environment. First, in terms of the macro environment, we're seeing a greater degree of caution and scrutiny of deals given the high level of uncertainty. As we're hearing this from our customers, it's leading us to be more cautious with our forecasts and expectations. Second, as we discussed last quarter and subsequently saw in other tech provider results, customers have been taking time since the start of fiscal 2024 to deploy the elevated levels of products shipped to them in recent quarters. and this is taking longer than our initial expectations. Third, we continue to see weak demand with our telco and cable service providers. They go on, but it's not a good picture. Global Foundries 2023 presented a unique set of challenges for the global economy and the broader semiconductor industry. Our customers grappled with elevated inventory levels, weaker demand, and a backdrop of tighter monetary policies. We're starting to see the inflationary headwinds moderate. The ongoing high interest rate environment has undoubtedly led to prolonged and deeper cyclical downturn than was first anticipated by many in our industry. And they start that with, although we are starting to see the headwinds, then these other things are arising. As for the outlook, entering 2024, we are beginning to see the rate of pace of inventory levels improving across certain end markets and customers versus last year. However, these levels remain elevated across most of the end markets we serve as the macroeconomic weakness and geopolitical concerns persist. Lattice Semiconductor, their CEO, while I'm pleased with the full year revenue growth, our progress in 2023 Q4 was impacted by the cyclical correction affecting the broader semiconductor industry. They go on, it's not great sounding. Wendy's, our U.S. company operated restaurant margin of 13.5%, contracted versus the prior year, primarily due to quarter-on-quarter accelerations in commodity inflation to mid-single digits, customer count declines, and labor inflation of almost 4%, back to those structural inflation forces, and so on. Ryder Systems, in terms of market assumptions, we expect macroeconomic growth to be muted in 2024. Market conditions in used vehicles and rental to continue to weaken in the first half of 2024, with a gradual improvement in the second half. So we'll see. Shopify, 2024, we plan to remain disciplined on headcount growth and find more ways to use AI. Expedia, interesting. In the fourth quarter, we saw strong revenue and EBITDA performance, but we did see some softness in gross bookings, and we haven't been hearing much of this, folks, but we've been expecting it. Driven primarily by air, which in turn was largely driven by a reduction in average ticket prices. As you all know, air does not impact revenue or profitability very much, but it does have an outsized impact on our overall gross bookings. Let's see. That's probably good. A little bit from Pepsi, but folks, you kind of get the picture. It's a very mixed signal, but I will submit that the number of negative commentaries are beginning to show some momentum, and right where we would expect, given what we see in terms of the underlying trends and the signals about the economy going forward. All the while, we are seeing some sentiment improvements. I said it in a recent commentary. Some of the improvements are actually some of the signals we typically see at bottoms when we want to start adding back exposure and taking on some risk to exploit the beginning of a new cycle. But typically, those signals are coming at the bottom of a recession, and we've got tremendous bargains to take advantage of. And of course, as I showed you, I think a week ago, these spikes in sentiment and some of this improvement that sometimes look like a bottom very often happens right before a recession actually begins, and I showed you that on the chart a week or two ago. So folks, jury's still out on all this, but there's enough out there to keep us hedging, to keep us very diversified, to keep us more liquid than we typically are, and to be in a position to do okay if the markets continue to melt higher. But right now, I think we need to have an eye on the downside through diversification and hedging and be in a position to take advantage of the downside if indeed something significant materializes. And I'll close right there. Thank you as always for watching and listening. I'll talk to you again soon. Bye-bye.